My name is Alec Lucas, and I'm one of our thematic research analysts here at Global X ETFs. I specifically cover our physical environment suite, which includes products that are aligned with renewable energy, electric vehicles, and most relevant for today, U.S. infrastructure. As a thematic research analyst, I'm producing a lot of public-facing content, including blogs and research pieces, as well as webinars and other presentations on our funds. I'm also addressing client and investor concerns. So if you have any questions about U.S. infrastructure or one of our other funds, I'm a go-to resource there. I've been at Global X for about 2.5 years, closing in on 3. But before that, I earned my bachelor's in finance from Fordham University in New York. And I'm also currently pursuing a master's in sustainability management from Columbia, also in New York. The Global X U.S. Infrastructure UCITS ETF, ticker PAVE or PAVE, is a thematic fund that tries to invest in these companies that could stand to benefit from a potential increase in infrastructure activity in the United States. Really what we're trying to do here is target the components of the value chain that could be stimulated if there is an increase in infrastructure activity domestically. Again, this does differ from a lot of our other thematic research products that are more geared towards a geographically agnostic approach. In this case, we think that there is a specific opportunity in the United States, and we do position the fund accordingly. So it's really important with thematic investing to first define these categories that we're trying to offer exposure to. In the case of the U.S. infrastructure product, there's 4 buckets we're trying to capture that we do think represent that value chain that stands to benefit. The first being construction engineering, these companies that are actually designing and working through construction projects. You also have products and equipment, which is anything from picks and shovels to heavy-duty machinery. You also have your raw materials and composites, steel, cement, asphalt, these building blocks of these construction projects. And then lastly, you have industrial transportation, which is essentially heavy-duty rail. In many cases, this is the only way to transport these products from point A to B. So once you have defined, these specific sub-themes, you can then identify companies that stand to benefit. And again, we are also applying a 50% revenue screen to the United States to provide that U.S.-centric exposure. In terms of how it's differentiated from other products, certainly that U.S. infrastructure exposure is a point of emphasis. But we're also think we're differentiated in terms of exposure to building these new infrastructure assets. A lot of other products are more centered around the maintenance of older and pre-existing infrastructure assets. So in both time periods, we have seen positive returns from the fund. Year to date, the fund is up about 18%. And then since inception, you're talking more like 10%. Very much over those time periods, the fund has benefited from structurally high demand for construction, some of which was pent up during the pandemic. You're also seeing positive sentiments towards the infrastructure bills that have been passed in the United States lately, which I'd be happy to dive into deeper. You've also seen industrials as a segment perform quite positively in 2023. And then lastly, you have seen materials prices in construction recover since softening to begin 2023. So that's also been supportive of performance as of late. We're seeing a lot of them right now, very much with the premise of the fund has been geared towards the likely return of federal investments to the space. And we did see that in late 2021 in the form of the Infrastructure Investment and Jobs Act, which is, in our view, a generational investment, about $1.2 trillion across a wide range of infrastructure areas that many of these companies could be quite exposed to. You also saw sort of a follow-up with the Inflation Reduction Act and the CHIPS Act, which aren't as direct of an investment in infrastructure, but we still could see quite a lot of momentum from those bills as well. Another trend is onshoring. Really, since the beginning of the pandemic, when vulnerabilities in supply chains were exposed, you have seen a lot of companies make efforts to bring back manufacturing to the United States. And that is, those bills I mentioned, the Inflation Reduction Act and the CHIPS Act, only add momentum there in terms of bringing supply chains back. And then lastly, and this is longer term, but climate change, both in terms of the impacts of climate change, increasing wear and tear on our infrastructure assets, which necessitates more renovation and improvement. But also the other corollary there is in terms of going through this energy transition, we need more transmission, we need more physical assets for renewable energy generation. So this also creates an opportunity for these infrastructure companies. The fund is very industrials heavy. Currently, you're talking about 70% of the fund is in industrials. Another more than 20% is in materials as well. And then beyond that, smattering of other exposures. This is very much a conscious decision. A lot of other traditional infrastructure funds are more utilities focused, which we certainly see the play there. We think that's more of an income play and more about maintaining pre-existing infrastructure assets. But in terms of building out new infrastructure and new construction projects, you're mostly talking industrials, and then sort of as we talked about before, the other part of the supply chain that stands to benefit is those raw materials, the cement, the steel that actually goes into these projects. So again, very industrials heavy, and that's a conscious choice to differentiate the product from other funds. I think to start answering this question, I'll first talk about expectations for the legislation we've seen recently. Guidance from these companies has been quite clear. The benefits from the overlapping benefits from the Infrastructure Investment and Jobs Act, the Inflation Reduction Act, and the CHIPS Act are likely to begin in earnest at the end of 2023 or the beginning of 2024, although companies have also cautioned that they're not likely to be maximized until closer to 2025, 2026, depending on who you ask. And then, from that standpoint, you're unlikely to see maximum spending from the infrastructure bill until later in the decade as well. So, we're in the early stages of implementation for those bills. The runway for growth is quite long, but we would expect to see sort of that maximum construction activity pick up towards the end of the decade. And then beyond that, I do also want to emphasize that even though these bills are generational and they're much needed and huge investments in the space, there's still likely trillions of dollars of unmet needs for the infrastructure space. So certainly in terms of the overwhelming challenges and opportunities in the United States for renovating our infrastructure assets, we're very much in the early stages for this theme. It's an interesting question. We would say it focuses on growth. Certainly compared to some of our other thematic products, which are geared towards technology that's in its earlier stage of adoption, we'd say that certainly the construction industry, the infrastructure industry are quite a bit further along. That being said, again, compared to a lot of other funds that are geared towards infrastructure maintenance and are more income plays with their utilities exposure, we do think that this industrials and materials focused strategy is more of the growth aspect of the infrastructure space.